Welcome to Mad Money. Welcome to Cramerica. Other people, my friends. Hey, man, I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach. Call me 1-800-743-CBC. Tweet me at Jim Cramer. On a daily today, you get a sense that many stocks have indeed gotten ahead of themselves after a very strong rally. When you've had major run and companies report terrific quarters, yet their stocks go down, that tells you something is wrong with those stocks, not with the companies themselves. A broken stock and a broken company are two very different things. And there are plenty of stocks today that broke, with the Dow tumbling 334 points, S&P sinking 0.53%, and the NASDAQ losing 0.93%, although we did climb out from an earlier hole. Now, a lot of people struggle with this whole concept of a stock being somehow different from the company it represents. It's easy to confuse the two and misread the action. But a whole bunch of stocks got clobbered today because of what we call profit taking. You know what? I find that term profit taking wanting. I bet you do too. So let me tell you what I do when I analyze a company on earnings day. And I do it in the quiet, okay? I don't look at the tape, so to speak. I don't see where it's trading. I just analyze it straight on. Take GE Vernova, General Electric's old power business, which reported this morning. GE Vernova is a very important company because it's responsible for plurality of the energy that goes into, yes, you guessed it, the data center, because they make the gas turbines that make so much of the energy occur. I saw the numbers come out over the wire this morning, and I immediately liked them. Company showed excellent order growth as it's become integral to the need to feed these data centers an extreme amount of electricity. They are gigantic gigawatt consumers, and GE Vernova is one of the very few companies that can generate enough power to sate these hungry behemoths. While the CEO, Scott Strachan, didn't raise estimates for the full year, he did paint an incredibly positive outlook on the conference call. The story only got better when CNBC's own Seema Modi talked to Scott, and he said that he'd been in contact with OpenAI's Sam Altman. Sounds like a big relationship could be in the offing. Every time some company announces an agreement with OpenAI, its stock tends to jump. That's what happened to AMD. That's what happened to Broadcom. That's what happened to NVIDIA. Maybe GE Vernova, which we own for the Chops Trust, maybe it could be next. There's only one problem. GE Vernova stock was already up almost 80% for the year going into the quarter. The stock was indicated up 25 points before the market opened, but in the end, management didn't raise their full-year forecast, and when your stock's up nearly 80%, you need to raise high the roof beam carpenters. Anyone know that book? It's pretty good. Next thing you know, GE Vernova is down 50 points. It wasn't enough that you had terrific order growth. The stock had already anticipated that, and more. We didn't get more, so what happened? Sell. Now, you got to ask yourself, is GE Vernova a bad company? Did it do something wrong? No, not at all. In fact, if you looked at GE Vernova stock in a vacuum, you'd want to be a buyer at these levels. A lot of people clearly agree with me because the stock erased most of its losses and finished just down $9. Okay, sounds a lot, but not on a $576 basis. No tragedy there. Stock wrong, company right. We saw the same thing with Vertiv, the data cooling center. You know, this thing is, we're going to have them on later in the show. This is a stock that was up 54% coming in the quarter. Terrific return. Company reported a shockingly great number. But I don't know a soul who follows this company who didn't expect a monster quarter. When you expect a monster quarter and you get a monster quarter, it won't be enough to move the stock. So after Vertiv opened up 10 points, it then plummeted 20 points because their monster quarter wasn't the kind of super-de-duper monster quarter where a Scooby-Doo would say, this time the monsters are for real. Or as Vertiv chairman and former CEO of Honeywell, Dave Cote, started the 11-day conference call with, "Good morning, all." Well, this is a very strong quarter by any measure, although I got to say, by looking at the stock price reaction right now, I wonder what would have happened if we hadn't blown the doors off of every single metric, end quote. Organic orders up 60%. That's crazy good. I was expecting crazy good, though, which is why the stock still got sting, because we got crazy good. We'll speak to Vertiv CEO later in the show, but once again, you need to know that nothing's wrong with Vertiv except the fact that the stock was already up a lot coming into the session. When you want amazing and you get amazing, your stock's up a lot, then you'll probably get a pullback. Now, I want you to contrast all this with the best performing stock in today's session, which is INTU, Intuitive Surgical. Here's a company that fell out of favor as there hadn't been as much utilization of their incredible Da Vinci surgical machine of late. This time, though, there was strong double-digit co-procedure growth, up 16%. And with the real kicker, Leerink Partners research said that those procedures grew because of after-hours use. That's greater leverage of fixed costs. Nobody saw that reacceleration coming, which is how Intuitive Surgical could rally nearly 14% today. How about if your stock's okay and you disappoint or you guide down? The former is how the market viewed Netflix today, and I'm going to be all over that later in the show. And when you guide down, if it's because of margin pressure, making less money per product, that's what happened to Texas Instruments, which sellers suddenly dumped en masse, taking the stock down 10 points or 5.6%. And I don't expect buyers to take that stock up anytime soon. Remember my thesis of the three economies, the data center, the real economy, and the speculative stocks? The data center stocks like Vertiv and GE Vernova struggled today, definitely. The real economy, they did fine. The speculative stocks, the pain continues.
The house of pain.
And in many ways, it was worse than ever. Why? Because of what I've been telling you. Speculative companies are taking advantage of their higher stock prices and raising money because they're short on cash. We're seeing insiders who are bailing because they can't believe the windfall that the overeager, speculative, and naive buyers are foolishly giving them. And we're seeing seasoned stock market veterans who know that when you see meme stock behavior all over the place, take up near worthless stocks, it's time to get out of Dodge. You see that Beyond Meat? They thought they had that one going. I think the data center stocks are going to work. I really do. I think they snap back. You know I like the real economy stocks because the bar for them is very low. So they can easily rally. Witness Capital One, COF, the credit card company, it rallied nearly $4 off a quarter that showed a dramatic decline in credit problems when many thought there'd be an increase. That's a textbook example of a stock rallying off of a real shocker. This charitable trust holding was up $10 at one point. I think it's going to go back there. But I don't think the speculative stocks are going to return to their previous heights of 2 weeks ago. I presume that they can bounce because that's what they do. They'll suck people back in. Gold will go up, or crypto, or, of course, gold standard Palantir, and the whole shebang will start rallying again, and you'll think, ha, here it comes. However, from my perch, when you get the kind of destruction of the froth that we've had in the last 10 days, it isn't easy to put Humpty Dumpty back together again. Even with the best of Elmers, he tends to stay broken. Bottom line, that's why I keep urging you to trim the stocks of companies you own that are losing fortunes, the ones that will have to sell huge slugs of stock in order to keep operating, the ones that are many don't even have revenues. I don't see the speculative plays returning to their highs from 10 days ago. If anything, many of them might be headed for the new low list. It is still not too late to sell them on the coming bounce, of which there will be one. That bounce worked to sell in 2000, and it will work for you again. Hutch in New Jersey. Hutch.
Hey, Jim, it's Hutch from New Jersey, Stockton, New Jersey. How are you?
I am doing well, Chief. How about you, Stockton? I buy you one of them old Blue Eyes martinis at the Stockton Inn, but I'm all jammed here.
Well, come back home.
Come back home. I wish I could. Never mind.
PayPal, what do you think about the company with the new CEO?
No. He's got to start delivering numbers. I mean, the guy's got to start delivering numbers. That is often the case. It's kind of like, an NFL team. If they're not delivering the numbers, I'm not going to come in and say, boy, how about them Titans? Okay, forget the Titans. Let's go to Mike in California. Mike.
Hey, Jim, a big booyah to you from SoCal. First off, I really appreciate everything you do. I'm a long-time listener, first-time caller, and club member, so thank you.
Thank you, Mike. We're doing everything we can to try to please club members, absolutely. How can I help you?
So as a former employee of ADP, I have a sizable position. As a retiree, I like the yield, but it's been tough to own the last few months. Should I sell some here or sit tight and wait for better days?
I'll tell you, it's funny you said that. I am just now beginning to read research that's negative about ADP. You know what? Thanks for nothing. The stock was at 329. Now at 283, we're starting to hear that things aren't good. I would stay put. I think you'd be fine. It is an excellent company. And by the way, I'm going to do a twofer. I like paychecks, too. I'm going to keep urging you to trim the stocks of the companies you own that are losing fortunes because I don't see the speculative plays returning their all-time highs anytime soon. And now I'm starting to see some really good stocks come down to buy. Oh, man, about it tonight. Here's a good one. Thermo Fisher stock has been range-bound the last few years. After reporting a beat and raise quarter this morning, could that be the catalyst to finally break out the stock? I'm sitting down with the CEO. You want to hear that one. Then could today's pullback in Netflix be a reason to buy, not sell the stock. I'm making sense of the move, and yeah, I got to tell you, I'm going to share where I think it's headed. And what the heck did happen today with data center player Vertiv? The company reported a strong quarter, but the stock did sell off in response. I'm dissecting the post-earnings action, so I suggest that you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
So what do we make of these numbers from Thermo Fisher Scientific, a company I've liked for so long? It's a big life sciences company. Reported a better than expected quarter this morning. These guys delivered a nice top and bottom line beat with accelerating organic revenue growth. So maybe the stock can finally get its groove back after mostly trading sideways for the past few years, all for legitimate reasons. Let's take a closer look with Mark Casper. He's the chairman, president, and CEO of Thermo Fisher Scientific. To learn more about the quarter. Mr. Casper, welcome back to Mad Money.
Jim, thanks so much for having me. It's great to be here after a terrific quarter where we really had outstanding financial performance and made great progress with innovation, completed a couple acquisitions, and a really exciting opportunity with OpenAI. So much to talk about today, Jim.
Sure. Now, someone said to me today, look, how do you know that they're back? And I said, do you know that they actually had good numbers with the academia? With the government, these were ones that you should have had bad numbers with. So I was surprised that if in the toughest market you still did well. China was actually good. So I have to believe you are really back.
I agree, Jim. In terms of the team, they did a really excellent job in the quarter. Nice to get 5% top line growth in Q3, and actually, nice to see the end markets are improving and our competitive position remains very strong.
Now, I've been waiting for the big hyperscalers to show some success in healthcare. Frankly, I've been let down. I don't see the breakthroughs until I read about your OpenAI collaboration today, which gives me hope to think that there are going to be some breakthroughs on the horizon. Tell me about how that came about.
Yeah, so Jim, in terms of the collaboration, you know our culture well, which is we have to be really convinced to take a step out in a new direction like this. And we've been working with OpenAI for a while. We're going to be able to co-create some new things and really focused on improving the drug development process, reducing the cost, shortening the time, and ultimately our customers will benefit, and of course patients will benefit as medicines get to market more quickly, and we'll be able to really bring out new capabilities in our clinical research business to make a huge difference there.
Now, one of the things I saw that you were working on, and it was in your news release, going next month is the Lou Gehrig dinner, which is for ALS, and I was talking to my wife, and my wife and I are going, and I said nothing ever happens with this disease. No progress ever. I think I have to correct myself because you are working on some unlocks for neurodegenerative diseases like Alzheimer's and Parkinson's. I'm wondering if you guys won't be able to start making some breakthroughs on these illnesses that no one even tries anymore.
Yeah, so when I think about one of the acquisitions that we did a little over a year ago was to expand our capabilities in proteomics, which is really for biomarker discovery. And we just launched a new set of capabilities this quarter, really focused on neurodegenerative diseases, the ones that you mentioned. They are such devastating diseases, and we're going to be able to help advance research, which ultimately will allow the pharmaceutical and biotech industry to really make progress here. And it is a really exciting time in terms of the understanding of biology and the impact it can have on patients, and certainly we're there to enable our customers' success.
So tell me how it works. Why are you the critical component in this? Why aren't they just going to, AstraZeneca? I mean, it does seem like or Bristol Myers. It seems like they go to Thermo Fisher because you're the one that understands the science of it and can get it done in scale?
You can think about what we're doing is we're helping those pharmaceutical companies, those biotech companies, the researchers in the leading academic medical centers around the world. We're giving them the tools to advance the science, right? We invest heavily, over $1.4 billion each year in R&D. It's really to enable their progress on turning the insights that we give them into medicines that benefit patients. And that's really the ecosystem that we power and why we're so well positioned for a very bright future.
All right, now tell me about where China is, because it sounds like that there could be some China stimulus at work. It doesn't sound like it's a lost cause, is the way I look at it.
Yeah, so when I think about it, we're delivering strong growth, and China continues to be a more challenged market. It's relatively small now for us because of the strong growth that we've gotten in the U.S. Today, China is about 7% of our revenue, and where we're seeing strength really is in pharma and biotech there. A lot of our Western capabilities are very valued by that customer base, so it's fine. I'd say the rest is challenged, but we're really focused on the other 93% of our revenue, and that's a great opportunity for us.
Well, that's why I want to talk about reshoring. I think your company uniquely understood that the mission is to try to get business built here. You've done a remarkable job. Tell me how that's going.
Yeah, so we made some commitments, about $1.5 billion of capital investments in the U.S. manufacturing, primarily for pharmaceuticals. We're probably the largest manufacturer of pharmaceuticals for the industry, and it's going incredibly well. As our clients, the large pharma and biotech companies, are reshoring their medicines to the U.S., we're seeing significant demand for our pharma services or our manufacturing capabilities to manufacture those medicines. So we're really benefiting from those changing supply chains. And we announced a really exciting acquisition this quarter. We bought a site from Sanofi. We're investing in it to expand it, which will give us more U.S. drug manufacturing capacity.
Excellent. And then the last thing, I've always liked Solventum. I know that they probably didn't need the filtration and separation business, but that is a gem of a business. How did that acquisition come about, and what is it going to do for you?
I agree with you. It really is a fantastic business, and it's a hand-in-glove fit with our bioproduction business. As you might remember, our bioproduction business is our fastest-growing part of our company, and this is a great addition of filtration, which is used to make essential medicines. And then ultimately, we've had the acquisition for about 7 weeks now. It's off to a great start. The team is excited. Customers cannot wait to get their hands on the technology, leveraging our trusted relationships. And we're really excited about delivering on the cost and growth synergies here and creating a brighter future for the company.
I'm really excited about Thermo Fisher Scientific being the company that I always remember. I know, look, there were so many things, whether COVID or China, you had to deal with all of these. But now all you're going to deal with is a great flight path higher. I want to thank Mark Casper, Chairman, President, CEO of Thermo Fisher. Beautiful quarter, sir. Thank you so much.
Jim, thanks for having me.
Absolutely. Mad Money will be back after the break.
Coming up, is it time to press pause on this stock? Cramer's breaking down the post-earnings move in Netflix and seeing if now's a buying opportunity or if it's time to cancel the subscription. Next.
Whoa. I mean, do we need to start worrying about the stock of Netflix? I mean, seeing the stock plunge roughly 10% today in response to a poorly received quarter, well, it's hard not to worry, isn't it? But I got to tell you, you know what? I think this sell-off is an overreaction. Keep in mind, Netflix is one of the best performing stocks of all time. Got to give it the benefit of the doubt. Going in the quarter, it was up more than 300% for the past 3 years. Hey, it's up 39% year to date. For the last 23 years, betting against Netflix has pretty much always been a huge mistake. That said, the stock's already pulled back pretty substantially from its highs in late June. And today's post-earnings beatdown was pretty darn brutal. So what the heck happened? Is this substantive? Okay, when Netflix reported last night, they delivered an in-line revenue up 17.2% year over year, in line. But their operating income came in shy, okay, a little bit light. They faced some serious margin pressure, and they only earned $5.87 per share. Wall Street was looking for $6.96 per share. At first glance, that's a pretty severe earnings miss. On the other hand, Netflix's cash flow numbers were phenomenal. And when management gave guidance for the current quarter, the revenue outlook came in higher than expected, but their earnings outlook was merely in line. They also cut their full-year operating margin forecast. Again, that's not great. But when you drill down, most of the earnings softness came from a $619 million hit related to a tax dispute with the Brazilian government. That expense covered a period going back to 2022, and it's something Netflix had warned about in the fine print during its regulatory filings. It still took people by surprise, but it was available if you looked. If not for the Brazilian tax hit, listen to this, they would have been able to deliver a monster earnings beat. More importantly, Netflix CFO Spencer Newman said, We don't expect this matter to have a material impact on our results in the future, end quote. In other words, it's pretty much a one-off item. And that encourages me more than ever to say this is your chance to buy the stock of this tremendous company. Buy. That's right. The biggest problem with the quarter is something we don't need to worry about going forward. But there were some smaller issues that analysts chose to quibble over. Latin America and Asia Pacific both came in a little light, for example. That's real. Other stuff seems ridiculous. And Needham came out with a piece groaning about how Netflix's lack of an AI strategy is bad, or that management seems too dismissive of competition from YouTube. They didn't announce any major strategic changes. I mean, look, these are all complaints that might make sense if the business was doing badly. But Netflix is doing great. They just got hit with a big one-off Brazilian tax charge. Take that issue off the table, and this quarter would have been phenomenal. However, I will say that it's become harder to judge Netflix ever since the company stopped reporting the regular reporting subscriber metrics and average revenue per user. That's why whenever the quarter doesn't go perfectly like this one, people do freak out. Because they can't tell what's truly going wrong. In the past, Netflix traded on subscriber numbers. As long as those numbers were good, nobody would have cared about a Brazilian tax filing. But we don't get those numbers anymore, which is, I think, why the stock collapsed today. Again, though, I think the sell-off in Netflix is giving you a terrific buying opportunity because I'm not worried about their business at all. I trust management when they say that the Brazilian tax issue won't impact the earnings going forward. And other than that tax charge, well, you know what? I saw a lot to like. For instance, they had the most successful movie of all time this quarter, K-pop Demon Hunters. And they just reported another quarter of accelerating revenue growth. I don't have a lot of companies that have ARG. For a company the size of Netflix to be putting up 17% revenue growth, I think that's pretty darn impressive. And they did it thanks to a combination of membership growth, price increases, and higher ad revenue. So there's some sustainability going on here. Plus, without that Brazilian tax hit, Netflix's operating margins are in the low 30s this year versus the high 20s last year. Rising margins. The company's operating margin outlook for the fourth quarter indicates a dip down to 24% for the final period of the year. But that's actually standard for Netflix in the fourth quarter, when the company typically launches some big budget movies and has big live events like the NFL games on Christmas. In the fourth quarter of last year, for example, Netflix's operating margin came in at 22%. So the 24% they're forecasting would still represent some nice year-over-year growth. Now, apart from the numbers themselves, I think the whole Netflix narrative remains extremely compelling. Let's talk about it. Engagement, that's really important. It was excellent in the third quarter. Company achieving its highest quarterly view share ever in the U.S. and the UK, thanks to an excellent content slate that included a new season of Wednesday and Adam Sandler's Happy Gilmore 2, and the hit South Korean series called Bon Appetit, Your Majesty, and their most popular movie ever that I mentioned before. Plus, the Canelo versus Crawford boxing match that became the most viewed men's championship fight of the century. Hey, by the way, Netflix's fourth quarter content slate looks pretty darn good, too. With the final season of Stranger Things, new seasons of popular shows like The Diplomat, I'm on like episode 4. It's pretty good. It's a lot of fun here. And Nobody Wants This, as well as a few big movies like Catherine Bigelow's A House of Dynamite. I think that comes out Friday. I got to tell you, I'm hearing this one's really extraordinary. And the third Knives Out movie, along with those NFL games on Christmas. Oh, and if you are unsure of what to watch yourself, I want you to go read the company's shareholder letter. Lisa and I get some of our best ideas of what to watch. We do fight over the thing, especially the foreign series that nobody here focuses on much, but are huge hits around the world. You got to check them out. It's one of the reasons why the company makes so much money. What else? Netflix has a new TV user interface. It's apparently been well received, although I don't love it when they change things up and you have to relearn how to navigate everything. They're using AI and machine learning to make content better, content recommendations also, increasing to save on production costs. That's what we want to use from AI. Finally, Netflix's rapidly growing advertising business is really starting to look great. Turns out the best way to make money off TV is by selling ads. Who could have guessed it? I expect a long runway for the ad business as the company keeps finding ways to improve its value proposition for advertisers. Plus, they can keep raising the price of an ad, the free ad tier, in order to push people toward the ad-based tier. I mean, this is really incredible. You get the free, they raise it, then people switch to the ad, where they make even more money. Oh, what a virtuous circle, long story short. While Netflix certainly didn't report a clean quarter, the biggest piece of hair on this thing was that major Brazilian tax charge, one off. I think it's crazy that the stock sold off 10% today, given that it was already down about $100 from its highs. Plus, after the sell-off, Netflix now trades at less than 35 times next year's earnings estimates, even though it's expected to deliver 26% earnings growth. This thing could sell 50 times earnings. It wouldn't be all that expensive. I think it's a fine price to pay. Bottom line, As far as I'm concerned, Netflix has great revenue growth. And aside from that Brazilian thing, its profitability keeps improving. They had a terrific content slate. Basically, nothing about this quarter makes me doubt the company. The only thing that's changed is the stock got a heck of a lot cheaper, which is why I think this is an incredible buying opportunity. Shirley in Mississippi. Shirley.
Hi, Jim. How you doing?
Hi, Shirley. How are you doing?
I'm doing great. Thank you for taking the call. I have some shares of Warner Brothers Discovery. I've been waiting for it to go higher to sell it. I heard about the announcement of the company splitting. Then I heard about the company being sold. Give me some advice, Jim.
Okay, I think you got to hold on to it. I think that the CEO David Zaslav is going to get you $24 to $27 a share. It's at $20. I would not sell this stock yet. And thank you for the call. Now, nothing about this latest quarter from Netflix makes me doubt the company's bull case going forward. And I think you're getting a terrific buying opportunity right now with this pullback. Made no sense to me. There's much more Mad Money ahead, including my exclusive with Vertiv. Talk about a stock that should have gone up today. It's the power and cooling equipment for the data center. A red-hot quarter, but the stock cooled. I'm getting to the bottom of what's going on with the CEO. Then, speculation is fine so long as you're doing it wisely, and many people aren't. I'm about to call you out once again. Believe me, I've been saving you money. I'm not going away. I'm going to be here again tomorrow. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what the heck just happened to the stock of Vertiv Holdings, the maker of power and cooling equipment that's been on fire because it sells into the data center? This morning, Vertiv reported what sure looked like a blowout quarter to me, a big top and bottom line beat with organic orders up 60% year over year, up 20% just for the previous quarter. Linked quarter? Management's guidance for the current quarter was excellent, and they also raised their full-year forecast across the board, as I said at the top of the show. Yet, after opening higher and setting a fresh all-time high just after the opening bell, the stock then reversed, eventually finishing the day down almost 2%. I think this was pure run-of-the-mill profit-taking, as I said at the beginning of the show, for a stock that was already up 50% for the year going into last night. I never blame anyone for ringing the register, even when the business remains incredibly strong. But a lot of people told me that maybe I'm too bullish, so let's not take it from me. Let's check in with Gio Albertazzi. Gio is the CEO of Vertiv Holdings. You get a better read on the quarter. Mr. Albertazzi, welcome back to Mad Money.
Well, thank you for having me. Good seeing you.
Okay, so Gio, first of all, you have to explain to people, when you have this kind of organic growth, and you've been in the business for a long time, this is extraordinary. Is there any way to explain a stock going down other than the fact that people were expecting the extraordinary and you gave it to them?
Look, very strong quarter, as you were saying, across all metrics. We're extremely proud and very, very encouraged by the direction of the market and our market share growth in that market. So all positive.
And backlog? How about backlog?
A backlog up 30% year on year to $9.5 billion. So extremely strong, projecting strength in the out years, of course. So very positive. I don't over-analyze and over-stress over a day. What matters is the long-term trajectory. And we're proud of a very strong trajectory. So we take a day at a time, and we are very confident about the future trajectory of Vertiv and the industry.
Okay, so Gio, you make the absolute finest cooling equipment in the world. Are you ever concerned? You'll read about someone who has a great, like I met with a CEO who had cryogenic, and he said cryogenic is going to be the next thing. But then when I speak to Jensen Huang, he says, Jim, that can't scale. You have to have scale. Your company is able to beat these other guys because they're all one-off and boutiques, aren't they?
Definitely scale matters a lot, but we are not scared about innovation. We're not scared about new technology. Indeed, we drive new technology as the data center industry is evolving rapidly, very, very rapidly, and we pride ourselves for being at the forefront of that evolution. So if there are new technologies, we welcome them. We embrace them, and we'll continue to lead with the new technology.
Now, you made an acquisition, and I want to be sure about it, because it does sound like that the acquisition is about having, this called Great Lakes, having more of the data center be yours, a bigger footprint in the data center.
Well, it's really a play in the white space the white space is where the IT really resides. And everything that you see in this video is white space, as a matter of fact. And the Great Lakes acquisition really completes our portfolio and strengthens our portfolio in the white space. We're very strong in the power and thermal, and the power and thermal happen in the building, and then they go into the white space where the IT resides, and that acquisition strengthens our presence there, where everything comes together. So very happy about that acquisition.
Okay, so Gio, how does it work? Are you hired by, say, a CoreWeave? Are you hired by an Oracle? Who actually brings in Vertiv?
Without mentioning specific customer names, some of the names you mentioned, of course, are publicly known customers of Vertiv. But typically, it's a multi-dimensional relationship. We work with the end users, such the examples, the names that you mentioned, but as well contractors, hyperscalers, installers, a little bit across the range. But our real strength is the relationship and the partnership we have with the hyperscalers, with the new clouds, with the silicon providers. So it's a multidimensional, and we've been playing in the industry for decades. And I think we are very, very well positioned in go-to-market and relationship from the relationship point of view.
Okay, so when you talk with your chairman, Dave, Cody, Gio, do you guys just sometimes just get amazed at how much business there really is, and how much of it will really be done versus how much of it is being announced?
Well, maybe not amazed, pleased. Let's put it this way. Amazed would mean surprise. We see the industry and we see where it's going. We see it in our pipeline. We see it in the conversation, a high-level, C-level conversation that we have with the biggest players. So I think there is a lot of substance in the announcements. Let's all be careful about the fact that those announcements then roll out, and rolling out those announcements take time, more time than the announcement itself. So we're very pleased with the direction the business is going and the market is going. Then
one last question. What happens if the data center cools? For not the business, but what happens if, say, everything is, they strip out the copper and they go with glass and they go with fiber inside? Then it won't burn so hot. Will they still need a company as high quality as Vertiv to cool the place?
It is not so much the copper or the other type of ways of transmitting data can very well come. What generates heat are the electronic components themselves, and that generation of heat will continue. If anything, there is a concentration of heat, and that's what we're addressing with technologies like liquid cooling and the evolutions that liquid cooling will really have in the out years. So again, let the industry transform. Always remember, we are the center of the evolution and transformation from a technology standpoint of the industry. So not afraid, actually very excited about the technology evolution.
Well, you should, and I think that you're the best at it. Everybody who knows the data center business knows that you're the gold standard. And if they're going to continue to build them out, you're going to get the business. Gio Albertazzi, CEO of Vertiv. Gio, I love having you on. Thank you.
Thanks for having me.
Absolutely. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time! It's time for the lightning round. Sam the stock total, buy, sell, so just go to the core stock, point time, Stanford, the way you later. So. And then the lightning round is over. Are you ready? Ski that total right. We'll start with Venkat in Arkansas. Venkat.
Hey, Jim. First-time caller and new club member. I want to begin by saying thank you for all that you do for the retail investor.
Thank you, partner. That's what I want. That's who I'm out here working for. And now we're going to work together. What do we have?
Yeah, I'm calling about a stock that's been a real loser in my portfolio. I want to get your opinion on buy, sell, or hold, ticker MNTN Mountain.
I looked at MNTN even for my wife's mezcal plus 4. I think it's such a good bargain. I don't know. I like the stock at 20, so I can't tell you at 15 that I don't like it. I've been wrong on MNTN, but I think it's a good company. I'm sticking by it. Let's go to Don in Pennsylvania. Don.
Booyah, Jim.
Booyah, Don. What's up?
Thank you. I just want to let you know that because of you, all 3 of our children came out of college, graduated debt-free.
Hey, thanks, buddy. I tried figuring out what the heck am I doing out here every night. You know what I'm doing? I'm helping this fella. I'm helping Don from Pennsylvania, hopefully from the eastern part and not from the Pittsburgh section.
No, we're from the Mechanicsburg area, John Ritchie.
Yeah.
So
John Ritchie. Yeah.
3 Mile Island is getting set to reopen. My thing is Constellation Energy.
You know what? Constellation Energy is real, okay? And they do make a lot of money. It's up so much, Don. I'm afraid to come out and tell you to buy it right here. It's up too much. It's good company, though. It's good company. Let's go to Philip in Pennsylvania. Philip.
Booyah, Cramer. First time calling here, calling in from our cabin in Marionville, Pennsylvania that you helped us pay for. Thank you, sir.
Thank you, man. Thank you. Hey, I changed people's lives. Look, I'm proud of it. What can I tell you? I didn't make it up. I don't know these fellas. Go ahead. I'm sorry.
That's fine. My nephew recommended MVST about a year ago. It was 22 cents at the time. It hit $7 last week.
It's still good. It's still good. It's got great free cash flow. It's not like the others. It actually makes money. This is not some joker speculative stock. That's why I said I liked it a year ago, and I continue to like it now. I like the stock. Now let's go to Mike in Florida. Mike.
Booyah, Big Jim. Go Eagles. Jim, my question to you this evening. There you go. My question.
Go Brandon Graham. What's up?
I know. Hey, UEC,
Go Howie Roseman.
Uranium Energy Corp. Buying or selling or going?
No, you're going in uranium energy. We had that. That's me, Scott Strazer. I got to tell you, the Cheever Nova was very enlightening. Don't buy these uranium companies. We're done, okay? They're up too much. We're not going to be shoveling new uranium. These are not like coal plants. They're not like forest fires. These are nuclear power plants. They take forever to build. There will be one that's going to open in 2028, but these ones that need this, I'm talking about 2035. We're not playing this game. We're, as Van the Man said, we're playing a new game. All right, let's go to Debbie in Georgia. Debbie.
Hey, Jim. Booyah. And I know it's a lightning round. I'll try to talk fast so you can get on to the next person, too. But I have to say thank you, as so many of us do, not just for the NVIDIA tips, but others. I'm a 1,400% gainer, money in my pocket, and continue to carry it forever.
Well,
so,
you should. Everyone wants to read that NVIDIA story. It's right in here. Now, it does make me proud. It would have made my mom proud. She would have said, you know what, Jimmy, you're okay. Jimmy, you're okay. You never got more.
Good. Yeah,
all right,
I'm happy. I got in early enough. I'm happy. Okay, so I did read your book, and if I'd read your book sooner, I probably would have sold this stock sooner. So I've had it. It's down about 70% for me, but it came up and rallied the last 6 months of this year. It's come back close to 30%, and that is Bill Holdings. What would you do?
Okay, David had a really interview with Jeff Smith, and he's from Starboard. They have 4 new directors. I am going to go with them and buy. I'm going to recommend buying Bill Holdings, and thank you for the kind words. Hey, thank you, everybody in the Lightning Round for kind words, because you know what? You go home, everyone knows I've been struggling with this book tour. I've been mad at everybody. I haven't kicked the dogs through in the kennel. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
I keep warning you that it's time to ring the register on these speculative stocks so you don't get wiped out like you would have on days like today. But speculation itself is not bad. In a 5-stock portfolio, like I suggest in How to Make Money in Any Market, I actually encourage speculation, especially for young people. You can have 1 spec when you're older, north of 25, say, and 2 out of 5 if you're even younger than that. A solid speculative pick can change your entire life, even if it's a high-risk proposition like NVIDIA was when I first started recommending it. You have my blessing to own 2 specs when you're too young, because you got your whole darn life ahead of you to make back any potential losses. But if you're going to speculate, you need to do it wisely. Searching for young companies with a clear line of sight to profits, not older companies that have lost money for ages and have no hope of generating positive earnings, maybe even sales in time or for the near future. Especially when, their stock prices have gone parabolic, as I keep talking about, and they need to raise capital. That's a recipe for disaster right out of the Donner Party cookbook. Which is why last night's lightning round really had me bummed out. I don't know the stock questions ahead of time, as I tell you every night, but I do follow a lot of stocks, and last night was just a wise speculator's nightmare. They know nothing! Let's go down the list in the order that I took them. The first was AST Space Mobile. Now, here's a stock that, though it's up more than 200% for the year, is set at 71 and change, is still down more than 30 points from its high just 6 days ago. I've been warning people that you have to start bailing when you see big financings like we had at the end of the dot-com era. Sure enough, AST Space Mobile, an intriguing cellular broadband play, just offered $1 billion in convertible notes and 2 million shares at 78 and change. It's lost money for the last 5 years with a $677 million in negative free cash flow for the last 12 months. I say no thank you. Next up is Trilogy Metals, up roughly 345% for the year, despite the fact that it's come down from 11 to 5 over just the past 8 days. Precious metals, rare earths, who knows? Trilogy's got no sales, hasn't in 5 years, been losing money year after year after year after year. Sold to you. Then there's Grail, a company that has a blood test that can detect cancer. Maybe. It's just got a readout for how the test works, and the results were mixed to positive. Grail immediately took advantage of a huge spike on the news and to do a private placement of $325 million. Now, I'm intrigued by the technology, but the company's been losing hundreds of millions of dollars in the last 5 years, and the stock is up 347% for the year. Don't call yourself early if you're buying this one, even as the stock has pulled back from 103 to 79 over the past 2 days. Next up, Tecogen. That's a cogeneration company called for cleaner energy for on-site cooling and powering of the data center. Their chiller is known as the TecoChill. The stock's up nearly 475%, even though it's now at 8, down from 12 last week. The company got a nice revenue ramp, but has never turned a profit. I kind of like this one, but it's really speculative. I prefer something more solid, like a Vertiv after this decline today. What a buying opportunity. Then there's Aurora Innovation. It's a self-driving technology company, trades at under 5. This is another company that's never made money in the last 5 years. In fact, it's lost hundreds of millions of dollars. Just go buy the stock of Tesla in the weakness. Then there's Rigetti Computing, a quantum computing company. Rigetti's up 136% for the year. The company has declining revenues for the last 3 years. It's losing gobs of money. Board member just sold $2.8 million worth of stock. Good for her. Or him, I don't know. I don't see how you can own a quantum computing play that's losing tens of millions of dollars with the results far off in the future when there's heavy insider selling. Now, I'm not saying that none of these specs will ever amount to anything. I am saying that the odds of these particular stocks making you money seem very slim outside of the speculative mania that we've been through, where you buy high and hope to sell higher. The mania does seem to have come to an end. In each case, there's a much better, higher grade alternative of the stocks I just mentioned. These are all just overheated junk that are due for a bounce, and when you get one, be sure to sell them, because we are just going to revisit these nasty levels once again before an even bigger breakdown, just like that of 2000, justifiably occurs. I'd like to say there's always a bull market somewhere. Promise that I find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.